Hello everyone, my name is Blaine Pearson and I am an instructor in Texas Tech's Personal Financial Planning program. In this video, we're going to pick up where we left off in part 1 of the Introduction to Excel and Portfolio Management. In the last video, we reviewed our client and how to arrive at the total percentage amount of assets using the value of the positions and the value of the total portfolio. In this video, we're going to pick up where we left off. After I get to the part where I have the percentage of total assets in my portfolio, I then like to look at the capital gain situation of the client. To compute the capital gain situation, I can look at the basis of the positions that the client has. From there, I can take the current value and minus that basis. So in Excel, you would enter equals the value of the position minus the original purchase price or the basis. From here, I can take this and drag it down. As we can see, some of the positions actually have a loss. What I like to do is highlight those in red to make them more apparent. If I want to see how much in capital gains she has, I can hit equals sum, parentheses, then sum all of the gains and losses. So combined, she has about $158,000 in capital gains. What I then like to do is take those capital gains and look at how relative those gains are to the basis of the position. What I mean is I like to look at the percentage amount that this client has made on her money. From here, I can hit equals the amount of gain in the position and divide it by what she originally paid for it. I can then take that number and drag it down. To convert this to a percent, I can simply hit the percentage button. This tells me how much percent gain she has had on her account. So she has made 186% on Apple stock. She has lost roughly 60% of her Snapchat value from the original purchase. Doing this allows us to compare the amount of loss she has in terms of percentage and the amount of gain she has in terms of percentage, so that when we make portfolio decisions with respect to taxes, we know how much we can free up with the least amount of impact. What I mean by that is if we look at 3%, it would say that in order to free up $78,000 worth of value in stock, it would only cost $2,000 of capital gains or 3%. So if we wanted to get the most amount of money while also incurring the least amount of capital gains possible, we want to look at this percentage. This is also helpful for when we want to take our capital losses and balance them with our capital gains. She has $44,000 in capital losses, meaning that if she sold the two positions that she had losses in, she could then use them to offset the capital gains. So if we wanted to free up as much money as possible while also incurring no capital gains, we could sell these two positions and then look for the percent amount that would charge us the least amount to free up cash. As we know, the long-term capital gains rate is 15% for most taxpayers, and the short-term capital gains rate is ordinary income tax bracket for most taxpayers. So what we can then do is look at freeing up the most cash possible, and if we need to free up more cash, look at if those gains are long or short and how much it would cost her in capital gains. If in fact this $158,000 is all long-term gains, we can hit equals 0.15 times the $158,000. This amount, $23,700, is the amount of money, assuming this $158,000 is all long-term gains, she would owe in taxes for freeing up and selling all the positions in her account. One interesting note is if we move to the 401k, there is no tax basis information. This is because the tax basis information in a 401k is irrelevant. As we know, you get a tax deduction for contributions into a 401k. You're then taxed when withdrawals are made from a 401k. So, buying and selling, short and long term, it does not matter inside of a 401k. Again, this is Blaine Pearson, and in this video, we reviewed part 2 of an introduction to Excel and portfolio management.